Innovation isn't a license to move fast and break things. It's a commitment to design systems that scale responsibly. Because in finance, broken innovation isn't a bug, it's a systemic failure. Welcome back to the Ether Vector. I'm your host, Maverick Adams. Last episode, we explored how venture banking, payments, and platform economies are being re engineered by intelligent systems. Today, we shift from what's changing to how leaders build the future without compromising trust. Innovation without guardrails is just risk with good marketing. Let's talk about structured innovation and how banks can scale responsibly in a world that expects both speed and safety. The new competitors in banking aren't banks, they're algorithmic decision engines. Their platforms wire directly into the economy. The future of capital allocation isn't decided in boardrooms anymore, it's decided in models. Look at recent failures, including Silicon Valley Bank and First Republic. They weren't failures of innovation, they were failures of governance keeping up with the velocity of change. Let's look at the case study Silicon Valley Bank. Silicon Valley Bank is our modern case study in the consequences of letting innovation run ahead of governance. This wasn't a story of failed ideas, it was a story of failed oversight. Silicon Valley Bank grew rapidly during the 2020 through 2021 boom and placed a tremendous share of its deposits into long term government and mortgage bonds when rates were near zero. That looked safe at the time, but it meant the bank was nakedly exposed to rising rates. When the Fed began aggressive tightening in 2022, the value of those assets collapsed far below their liabilities. A classic duration mismatch that left Silicon Valley Bank technically insolvent on a mark to market basis months before failure. Even worse, Silicon Valley Bank's deposits were massively concentrated and uninsured, over 90% above FDIC limits held by tech startups that move fast and burn cash. When confidence wavers, that customer base withdraws with a click, not a line around the block. Then came the spark. Management sold $21 billion. Let me repeat that, $21 billion in bonds at a $1.8 billion loss to shore up liquidity and announce a capital raise. The message wasn't, we're strengthening. The message landed as, we're in trouble. Venture investors told founders to get out now. And in 24 hours, $42 billion, let me repeat that, $42 billion attempted to exit the bank, the largest digital bank run in history. But here's the real lesson. The failure began long before the run. Supervisors had warned Silicon Valley Bank's board for years that interest rate risk oversight was insufficient. Examiners even downgraded governance and controls to deficient. And yet, the bank removed its hedges in 2022, choosing short term revenue optics over balance sheet resilience. For 8 critical months during that period, Silicon Valley Bank had no chief risk officer, while rate risk was exploding. That's not innovation, that's negligence. The collapse wasn't unpredictable, it was unacknowledged. Now, to understand the magnitude of what happened at Silicon Valley Bank, we need to look at the parallel collapse unfolding just down the street, First Republic Bank, because this wasn't a one bank idiosyncratic failure. It was a structural warning. Different clientele, same core flaw, same ending. First Republic didn't bank startups, it banked affluent individuals, private wealth clients, and coastal professionals. Their growth model was actually very simple: offer extremely attractive, low rate jumbo mortgages to high net worth clients, win their deposits, and grow by cross selling. And for years it worked until the environment changed. Between 2019 and early 2023, First Republic grew to $233 billion in assets, almost identical in scale to Silicon Valley Bank. But behind the pristine brand and elite concierge model sat the same structural vulnerabilities: long duration fixed rate loans held at below market yields, a heavy concentration of uninsured deposits between 67% to 73%, unrealized losses locked inside the balance sheet as rates spiked, a depositor base that could move billions with a single phone call. Sound familiar? When Silicon Valley Bank fell in March 2023, fear traveled at the speed of fiber. On March 9th, as Silicon Valley Bank depositors were withdrawing $42 billion in hours, First Republic customers also began quietly pulling funds. And by March 13th, they had withdrawn $25 billion in a single day. That's about $17 billion, 17%, of deposits gone in 24 hours. And so, to survive the week, First Republic had to borrow over $100 billion from the Fed and the Federal Home Loan Bank. Then came the now famous rescue attempt. 11 major banks deposited $30 billion to try to stabilize the system. But confidence wasn't restored, it only paused the bleeding. By the time First Republic reported earnings at the end of Q1, the truth was out. Over $100 billion in deposits were gone. Their deposit base collapsed from roughly $176 billion to $104 billion in one quarter. And that $104 billion included the $30 billion rescue infusion, meaning actual customer outflows were closer to 70%. Once that number hit the tape, the game was over. Confidence evaporated. The stock plunged another 50%. Depositors with resumed withdrawals. No private capital would touch it. And so on May 1st, 2023, a mere 52 days after Silicon Valley Bank failed, First Republic became the second largest bank failure in US history. JP Morgan acquired the remains. Shareholders were wiped. Depositors were made whole, but confidence in mid-tier banks took another blow. SVB catered to startups. First Republic catered to millionaires. Different clientele, different portfolios, but the same fundamental error. Long duration assets funded by unstable, uninsured deposits in a rising rate environment with no credible exit strategy. And the blind faith that their depositors would stay loyal. When fear hit the system, loyalty evaporated, and money moved faster than governance could react. That's not a startup banking failure. That's not a private wealth banking failure. That's a risk governance failure. Twice. And in a digital economy, you don't get time to react. Confidence evaporates in hours, not quarters. And this is the point. When risk is underestimated and velocity is ignored, innovation isn't dangerous. Complacency is. SVB and First Republic didn't fail because they were too innovative. They failed because they didn't innovate where it mattered most: in risk discipline, liquidity strategy, and crisis speed thinking. The risk landscape has evolved beyond the traditional pillars of credit, market, and operational exposure. Because if one failure is a warning, two failures are a pattern. And the pattern here has nothing to do with innovation and everything to do with governance. So the insight here really is that innovation did not break these banks. Governance broke these banks. Because they optimized for revenue today, reputation today, convenience today, but not survival tomorrow. And, as one post-mortem put it bluntly, a truly innovative bank would have innovated in risk, and they did not. So here is what these failures reveal about modern banking. The faster money moves, the faster confidence evaporates. And confidence is the only real currency a bank has. This is the new face of risk. The speed of panic, the complexity of the balance sheet, the transparency of social signal cascades. Which brings us right here. Today's risk isn't just credit, market, or operational. We are confronting entirely new dimensions of exposure. Speed risk, innovation outpacing oversight, complexity risk, black box decisioning, transparency risk, unclear ownership of outcomes. Governance can't chase innovation, it must be built into innovation. So here's the rule I live by: trust, then validation, then scale. In that order, every time. Inside every financial institution, three questions quietly decide the future: who gets to innovate, how fast can innovation move, and what risks are acceptable. To answer those questions, banks need architecture, not slogans about being agile. I use a framework I call the triple guardrail model: data guardrails, model guardrails, and market guardrails. And here's the organizational truth: innovation does not fail because the idea isn't good. Innovation fails because the controls aren't ready. In modern financial systems, we do not scale products first, we scale control, we scale evidence, and then we scale the idea. This is the discipline that separates institutions that innovate safely from those that innovate recklessly. Three guardrails, three lines of protection. One purpose: accelerate progress without accelerating fragility. Now let's break each one down clearly, practically, and in operational terms. Data guardrails, clean inputs, and lineage clarity. Every financial failure begins with a misunderstood input. Data guardrails answer a simple questions. Do we actually know what the model is looking at? In practice, this means data lineage, quality controls, and proper access governance. Regulators are no longer accepting data as a black box. Basel's BCBS 239 forces banks to show where data came from, who touched it, and how it changed. Because fragmented, low quality data produces beautifully wrong AI. You get precision without accuracy. And leading banks are responding. JP Morgan mandates data integrity checks before pilots advance. Singapore's ABS Gen AI guardrails call quality data a non-negotiable foundation. As one banking leader put it, without clean inputs, innovation isn't intelligent, it's reckless. Data guardrails give innovators permission to move fast because leaders trust the ground beneath the model. Number two, model guardrails. Transparent decisioning. What the industry calls explainability and automated control triggers, often referred to as automated tripwires. In other words, the model needs to tell us why, and the system needs to step in the moment reality deviates from design. Model governance protects against the unknown unknowns. Opaque decisioning is unacceptable in credit, treasury, trading, and in AI driven personalization. We also need visibility into why the system reached a decision, what's often called model transparency. In technical terms, that means using explainability tools like SHAP to unpack the drivers behind an output. If we can't explain the decision, we can't defend it. And if we can't defend it, we can't scale it. Human understandable logic unlocks compliance, internal trust, and faster approvals. Then tripwires. Automation that catches mistakes faster than humans can blink. An example is the Lloyd's Banking Group. Their responsible AI framework monitors every input and output in real time. And if a risk score goes red, the system itself pauses the feature and logs the event. That is machine supervised governance, the future of control. And regulators are aligned with this future. Under SR 11-7, the supervisory standard for model governance in banking, they expect models to be continuously monitored and for firms to intervene the moment performance drifts, not months later in an audit cycle. And across the Atlantic, the EU AI Act goes a step further, treating advanced models as critical infrastructure and requiring documented control integrity before scale, not just monitoring after deployment. The message globally is clear. Innovation scales safely only when governance scales with it. In other words, oversight must move at algorithmic speed, not legacy risk committee speed. When models self-correct, executives greenlight innovation faster. Guardrails are confidence enablers. They don't slow progress, they accelerate trust. And then number 3, market guardrails. Contain exposure and learn before scale. This is where banking learns from big tech. In the market layer, we borrow from modern software discipline, controlled rollouts, feature gating, and real-world telemetry. Instead of a single big bang release, we start small, 5%, then 25%, then scale only once stability, fairness, and performance are validated in the wild. You don't scale the idea, you scale the evidence the idea works. If something breaks, only a slice of customers feel it. The entire bank doesn't bleed. And regulators are increasingly aligned with this model. They're encouraging controlled experimentation, supervised sandboxes, limited exposure pilots, and hard caps on scale until behaviors are proven safe in the real economy. In other words, innovation is welcome, but only with guardrails, telemetry, and grown up supervision. Internal controls act the same way. Every stage of growth must re earn approval from its governance before scale comes into view. A McKinsey insight says it best: guardrails catch failure early and quietly. And this isn't just a US conversation, it's global. Regulators and policy bodies are converging around a single principle: innovation and oversight must scale together. From NIST risk management standards to the EU AI Act ex ante controls to mass Singapore and the BIS shaping cross border guardrails, the world is moving in the same direction, and everyone is converging on one idea. Risk first doesn't mean risk averse. Firms like Lloyd's, HSBC, BBVA, and Capital One have codified guardrails to accelerate innovation, because when trust is engineered, growth scales itself. This has become the new competitive edge. Trust built into the architecture and not bolted on after the fact. Bad innovation is expensive. Bad controls are catastrophic. Guardrails aren't bureaucracy, they're safety features for the bold. If a bank wants to take big swings, it must build systems that catch big misses before they cascade into headlines. So, no, guardrails do not slow innovation. They make innovation survivable, scalable, investable, which brings us right back here. Guardrails aren't barriers to progress. They're safety features for ideas worth scaling. Structured innovation accelerates trust. And when leaders trust the system, innovation speeds up. It gives innovators permission and executives confidence. Let me make this real for a moment. In a previous role, we were exploring how AI could accelerate decision cycles inside a large HR function. And immediately alarms went off. Some leaders feared AI meant losing control over deeply personal employee outcomes. Others worried that not moving fast enough was the bigger risk. This is the universal tension: speed versus safety. So we reframed the work around three questions: what can AI support? What can AI accelerate? And what decisions must remain fully human? We created tiered guardrails. High impact decisions retain human oversight. Low impact tasks automate, test, and learn quickly. Here is what happened: people didn't feel replaced by AI, they felt empowered by it. Because people trust what they help build. When governance is collaboration, innovation becomes unstoppable. Today, humans supervise machines. Tomorrow, machines supervise machines. We already see it in fraud detection, treasury optimization, credit decisioning, model risk controls. The next decade of banking will revolve around three anchors: guardrails by default, built into system design; supervision beyond humans, AI monitoring AI; and governance as competitive strategy. Trust becomes monetizable. Today, humans supervise machines. Tomorrow, machines supervise machines. We already see it in fraud detection, treasury optimization, credit decisioning, and model risk controls. The next decade of banking will revolve around three anchors: guardrails by default or built into system design, supervision beyond humans or AI monitoring AI, and governance as competitive strategy or trust becoming monetizable. Here's the big unlock: if a bank can automate trust, it can automate growth. The institutions that win will be those who build decision architectures that never sacrifice accountability. Structured innovation resolves the exact tensions holding organizations back: growth versus governance, speed versus safety, profit versus prudence. The future belongs to leaders who embed trust into every decision and every line of code. We must innovate boldly, but we must innovate responsibly. That is how platforms scale. That is how industries transform. That is how financial ecosystems remain resilient. Today, we explored why guardrails aren't constraints, they're confidence systems. We learned how to build the innovation superhighway with lanes, signals, and safety rails so that new ideas reach their destination without crashing the system. If this conversation resonated with you, connect with me on LinkedIn, Lewis Adams. I'd love to hear your perspective. Next week, we explore the quant human, the new leader who operates where intelligence, capital, and code converge. Architect the innovation superhighway. Until next time, this is the Ether Vector.